Welcome to Philip Roundtable. My name is Kim. I believe this is a very good time to talk about Trump's policies as well as investment strategies moving forward. We are honored to have two distinguished speakers from different fund houses. I'd like to introduce Ms. Yvonne Tan Hong Yan, CFA, Head of Equities, East Spring Investments Berhad. Yvonne is with East Spring Investments Berhad for more than 15 years. She's currently heading the equity team and overseeing all the equity funds in East Spring. Prior to that, she was heading the investment team, insurance, overseeing more than 20 billion ringgit funds. Yvonne has 28 years of experience in the investment industry, comprising 21 years in fund management and 6 years in investment research. Yvonne has experience in managing the domestic and Asia-Pacific equities as well as balanced funds. Prior to joining East Spring, she was a senior investment manager in a leading multinational insurance company, and she was also one of the pioneers of a local and Singapore-based asset management company. Yvonne obtained her CMSR license in March 2016 from the Securities Commission Malaysia. Yvonne holds a Bachelor of Science First Honours, and she graduated from the Association of International Accountants, UK in 1993. She's a CFA charter holder since September 1998. Our second speaker is Mr. Tan Chi Siong, Director Intermediary Digital PRSA at AHAM Capital. Tan Chi Siong is a Director of Intermediary Digital and PRS at AHAM Capital. In his current capacity, he is responsible for driving business development and managing relationships with key distributors and business partners. His role includes overseeing the Institutional Unit Trust Advisors (IUTA) segment, expanding the firm's PRS business and spearheading the growth of digital distribution channels. Since joining AHAM Capital in 2010, Tan has held several leadership roles across different business segments. He was instrumental in growing the firm's retail presence as head of personal wealth business before transitioning to the intermediary business team in 2020 to strengthen the partnerships business. In January 2023, he took on the added responsibility of developing the PRS business, and in April 2025, his portfolio was further expanded to include digital distribution channels. Tan holds a Bachelor of Arts Honours degree in Business Administration from the University of Aberdeen, Dundee, United Kingdom, and a CFP. He began his career in consumer financial services within the banking sector. Let's start with the first question. Allow me to pose this question to Yvonne. Right? We all know that Trump has been very uncertain in his policies. Right? Now we are currently enjoying a 90-day reprieve from the reciprocal tariff announcement, which was announced probably in April 2nd. But of course, now we noted that a lot of sell-side brokers have actually increased the likelihood of US recession to as high as 65% by JP Morgan. And a lot of brokers, including some of the economists, have also downgraded the economic projections. So how should investors adjust their strategies to navigate these risks? Thank you.
Okay. So in the first quarter, after the announcement on the tariff and all that, the certain development, we actually observed some shift happening in the market. One obvious shift is actually from the west to the east, or particularly out of US to either Europe or to the east. When to the east means mainly to China, Japan, and some parts of Asia. Okay. And also, there's another shift that is happening that are actually moving from the high volatile to low volatility kind of strategy. So this is happening, and also people are actually shifting a bit from the growth to value. But growth to value is something that is interchangeable depending on a certain situation and all that. So this is what mega trend is happening, that there are some shifting from west to east, shifting from high wall to low wall, and also partially also on certain bond market, like for example Malaysia, our side is actually turning slightly more positive on the Malaysia bond. On the equity side, we are actually a bit cautious right now because of what happened in the recent development. On the impact of tariff, right? Because currently all this strategy, all these policies are not fixed. Nobody really know what is happening. Everybody is just guessing possibility of recession, possibility of impact on the global growth. Let's assume that if the global growth were to impacted by a slowdown in US and slowdown in China because of all these things, to about a certain percentage, maybe 1 percentage point cut, then translate to Malaysia side, we may see also about 1 percentage point cut in terms of GDP. We are not talking about recession. We are talking about from 5% initially to about 4% or slightly lower than 4% GDP. So it's still a growth in Malaysia. Everything is still intact, but the sentiment-wise and the PE multiple that investors are willing to pay for equity market because of the risk premium may have changed. So in this environment, our advice to the investors is actually to stay defensive right now, stay invested, but stay defensive, not to put everything into one basket or put all your bullet out because there's still uncertainty out there. But portfolio-wise, stay defensive. And if possibly you have any of a strategy that is going into the low volatility, this may be a chance to actually go into low vol, go into high yield, and also go into, for Malaysia case, you may consider the bond market, which is still very robust right now.
Thank you, Yvonne. I think it's very clear. We all know that in this uncertainty environment, environment full of volatility, it's good to stay defensive and focus on quality amid volatility. Mr. Tan, from AHAM capital perspective, how do you think that investors could actually, be positioned in this kind of uncertain environment?
Hey, hi, Tim. Good afternoon, everyone. Thank you for dialing in today, and thank you for having me represent AHM Capital. Okay, so for AHM, how do we look into the current market is that even if you look at for the past 1 to 2 years ago, 2024 or 2023, we have already seen the growth sector, particularly in the technology, has done very well. And during the beginning of this year, even before the noises coming through or implementation of the proposed tariffs by President Trump, we already started to see the value and the defensive sectors started to slowly outperform the growth sectors since beginning of the first quarter of this year. And with the tariff implementation and the proposal coming through, we will say that it is still very fluid at this point in time, as we can see that President Trump has been changing his mind when it comes to the proposed tariff. And on and off, every few days now and then, he will come out with certain exceptions. And at the same time, he do have a spokesperson from his Trump administration team, and they can actually provide a different message or messaging out to the market on the same day, right? I think we have seen this over the past 1 week ago. And with all this uncertainty, what we think is that for investor, because based on your investment risk profile and objectives of your investment, one should look into the portfolio diversification according to your personal risk appetite. And if you to ask AHM, what we are recommending is that the client should have a portfolio diversification on the equity and also on the fixed income or the bond side. And last but not least, as we can see today, the hard metal commodities such as gold also has been driven over the years by the increasing of the central bank buying, especially from the Chinese government. So with that, we think portfolio diversification is the way to go for client who doesn't like the portfolio to be too volatile. Yeah.
All right, thank you, Mr. Tan. I think the message here is also very clear that diversification always can probably help investors to lower their overall portfolio risk. I would like to invite Yvonne into this discussion because we see that now after Trump announced the reciprocal tariff announcement on 2nd April, but of course there was some on and off announcement, right? Now we enjoy the 90-day relief, right? But of course, no one is going to know what is going to happen after these 90 days. But we are very sure that now, currencies like dollar has actually weakened since the announcement, I think it has dropped more than 5%, right? And a lot money is actually flowing to the likes of Swiss currency as well as Japanese yen. So do you think that this kind of flows will continue, or probably after everything we get a better picture on how Trump's policy is going to phase up, probably dollar can actually strengthen again? What's your view, Yvonne?
We are not expert in currency, but for now, because of the heavy selling in the Treasury, US Treasury, and also some of the recent weakness in US dollar, it looks like US dollar weakening trend may continue for a while. Okay. And you also have to see which are the other country they're talking about. US dollar weaken against what currency. So if you're talking about Europe, because Europe is, especially Germany, is now starting again to spend, fiscal spending, they're going to increase quite a lot. So optimism is going back there. And also you're talking about they could be, Japan is a bit different. Japan is in a tightening cycle rather than easing cycle. So it's actually in favor of Japan yen. So Japan yen strength is on its own because of the tightening continue. Okay. So US dollar versus the rest. So US dollar versus emerging market, we say that maybe US dollar may weaken against emerging market, may not be all. Like for example, versus yuan, that again depend on China policy and all that. We are not buying the idea that yuan will strengthen. So more so a reason for yuan to weaken for export purpose, for other purpose and all that. So that again also depend on Asia and Malaysia and our neighboring country, because of there's a lot of trading with China. Our correlation with our ringgit correlation with renminbi is also quite high. Okay. So we may not benefit too much on this US dollar weakening. US dollar weakening, you're talking about the index is weakening, but versus what currency, versus what other major currency and all that. In terms of Malaysia, at least if our ringgit is stabilized at the current level, we are okay. We're not talking about US dollar weaken against Malaysian ringgit, because we are also have to monitor the China situation and the direction of our renminbi. Okay, so for now, currency do have a lot of impact on the flow and all that, but the flow are also impacted by different other factors. There are many other factors to consider. So this is our view, that I think ringgit may stabilize at the current level. We still have to monitor very closely on the movement, the direction of yuan. That means renminbi. Yeah.
All right. Thank you, Yvonne. I think very clear. I think in the earlier part of the discussion, you also mentioned that there has been some funds rotating out of the US into Europe and Asia because of the heightened US policy uncertainty. And the series of events definitely have shocked the foundation of the long-held narrative of US exceptionalism. How should investors be positioned?
Okay, so because US as a start of this correction, starting with a higher PE multiple, so valuation is actually starting point is high, and also starting point is also they have their tech company valuation are actually quite high, and now they are actually exposed to a lot more downside if global supply chain is impacted, and all this tariff is going to impact some of the sales, especially the sales to China on some of their mega tech company may be impacted. So that part is already pretty negative to US. But just purely from valuation angle, US is also sitting with quite a lot of profit. So no harm to take profit, shifting a bit from the US side to move into some of the market that is relatively cheaper. Asia are relatively cheaper. China, even though bounced from the low, but it's still relatively so much cheaper. So you're talking about 13 times PE for Asia Pac. You're talking about still about 12 times or so for China. So it's actually a cheaper market to look at. So for China, there's also expectation that the AI driven idea will continue to spark more interest into the other sector, and also they are hopeful that the China government may do something to boost their domestic economy to fill up some of the gap of the export concern, especially from the trade war with US. So a lot more they need to do something to boost the domestic consumption, and the market is actually hoping to see more of this as a catalyst for the China market. To begin with, the valuation is actually on the low side, so it's not too expensive to start with. Whereas for US, they start with a higher valuation and a lot of profit that you can actually take some of the profit off and shift to the other market. As for Europe just begin of this excitement of spending again. So we haven't seen that for a long time. So yeah, this is quite interesting going forward if they really spend more on infrastructure and build up their defense.
All right, very clear. I think Yvonne actually mentioned that the rotation is mainly because of the valuation of the US equities at the higher side, right, compared to Europe and Asia from the beginning of the year. Mr. Tan, would you agree that probably the fundamentals of the US as a market has actually been challenged because of a series of events that's being happening right now, and of course Trump's policy-induced uncertainty to the market?
Yes, I do agree. And if you look at how market has been pricing in and behaving over the past few weeks, is that markets started to pricing in that slower growth in the US economy. That is due to the higher tariff that President Trump has imposed to the rest of other economy, because of the effect that is coming back to US, that which means that higher prices that for the US consumer to pay, and that is slowing down on the consumer spending moving forward. So this is what exactly the market is trying to price in. But the other thing also, I think we also need to take note is that in a more practical economy, especially for Trump, for Trump himself, he is a businessman, and also for the group of the Trump administration, many of them, they are billionaire businessmen. And furthermore, the Treasury Secretary himself is an ex-hedge fund manager. And they themselves, they definitely know what will be the impact if the proposed tariff is implemented. I think that's also the reason why Trump has mentioned that, the current tariff that he has proposed have been mentioned and announced is the maximum. And then now it's up to the respective of the country, how they are coming to the table for negotiation and what do they have to offer for the United States economies, right? And investment as well, in order for them to further lower down the tariff. And he himself, he knows exactly that the current tariff is going to hurt US economy, and that is not good for him as he's preparing for the 2026 midterm election by November. What we think is that during this period of time, he's trying to putting at the higher level of tariff proposal to negotiate and whatever he can get from the rest of the other economies within the world. And from there onwards, you should start to stabilize the market as heading towards the second half of the year. And by next year, he need to start to drive the economic growth to prepare himself for the midterm elections. So I think that is some things that also we have to keep in mind, whether how aggressive that Trump can go on this particular tariff implementation. Yeah.
Very clear, Mr. Tan. So a follow-up question, since we are talking about China, right? Do you think that probably whatever strategies or policies that are being implemented by President Trump is also to seek for decoupling from the Chinese economy?
Unlikely, as we know that China and US, they are still heavily dependent on each other's when it comes to supply chain, when it comes to trade. And Trump himself is definitely aware that it's not that easy to move back most of the supply chain back to US. And if you ask a simple question on American, whether how many Americans they willing to work in a manufacturing, in a factory, as a factory workers, right? So that's a very simple question that I think most of us, we should have answered by ourselves. And not everyone in the US or American, they wanted to be a factory workers. And unlike China also, they do have much more comprehensive ecosystems and supply chain when it comes to manufacturing and producing some of these materials, and that is important for US manufacturing to assemble, right? Example, some of the certain supply chain parts, the outdoor parts or the semiconductors, right? And things that are currently is not established well in the US to manufacture, but it likely will be very expensive, right? For some of these supply chain to move back into US, and that will bring back and even to raise even more higher inflation. And high inflation is definitely a no-no to President Trump as he's preparing himself for the next elections. I think what he's trying to do is that to get the interest rate coming off, and at the same time to lower down the 10-year treasury yield. In fact, that's what he's trying to do. He can't get Federal Reserve Chairman Jerome Powell to do it at the same, which means that he need to bring down the inflation. In fact, he need to bring down inflation in order to encourage the Federal Reserve to cut interest rate by second half of the year. And that is also something that he wanted to achieve to prepare for the midterm elections in 2026. So if the objective is to bring down the inflation, in fact, tariff implementation, it doesn't support that particular objective, which means that during this period of time, we think the noises on tariff will still be around for a while. But as we're heading towards the second half of the year, we are expecting the noises of tariff will be gradually slowing down with more clarification by President Trump himself. Yeah.
All right, thank you, Mr. Tan. I think it's very interesting to see how things gonna phase out in the next couple of months. Probably we'll see another strategic shift within the economic and the political landscape. Over to you, Yvonne. Since we are also talking about China, right? Recently, I think fresh from our oven this morning, China has announced first quarter GDP growth. It's quite impressive, 5.4%, right? I think that's also because of a lot shipments have been pre-arranged ahead of the tariff in the second quarter. So going forward, how do you view the Chinese economy? Just like you mentioned that there could be some domestic oriented policies that are going to be implemented by the Chinese government to support the growth. Apart from that, is there any other bullet or weapon that probably China can use, right, to counter-react whatever external challenges that the country is facing?
Okay, the external challenges is actually quite real. Of course, the number, whatever number they show out will be actually the number in the past. So tariff is going forward, what number you're going to see. So the slowdown will come, and will come if this tariff has continued to stay high as what the two parties are not talking yet. Okay, because what US want is China to initiate the negotiation, but I don't think China wanted to start anything on that. I think they are quite firm. So if the full implementation of the tariff is going to hit both, and it's going to hit China quite badly also, whether they can actually boost domestics a lot more to offset that is a big question mark. I think it's very, very challenging. So the downside risk of China growth is real. But growth is one thing, market is another thing. The reason is because market also have other expectations like the flow, like a view on what sector that you're talking about. Because the reason, remember that last year China has actually surprised because very low expectation in the market start to begin with, very low valuation, very low expectation, and when the government come out to say something positive, it excites the whole market, and the market overreact on that. Okay, then later you have another thing cool down, and then they have another trigger because of the DeepSeek and related, that people started to put more focus into the technology stocks and those that can be AI driven kind of a thematic play. So that thing is actually continue. It's just a beginning. So there is a lot of excitement on the high tech, on the supply chain, on some of these things. But economy-wise, it's still facing a real challenge if this tariff US tariff is to be implemented, seriously implemented, and both are actually at a real trade war. Okay, so the slowdown will happen. So I don't think for now the slowdown is going to be offset fully by any of the domestic boosts that they can do, but any of the domestic measures that come out will be able to excite the China market. So that's why I wanted to say that China market to begin with is not expensive, valuation quite attractive, and they have a certain sector that actually can be a big attraction to investor, and it's under own market. Whereas the other market is quite crowded in US. So because of that, some announcement, whether it can really filter into a real economic impact is one thing, but any announcement on the positive side or excitement side is going to excite the market in the short term for the sentiment wise. So this is our view. But the challenge is still there. So if they don't talk, both parties didn't talk, and the tariff were to implemented, the impact on the downside risk is huge for the economy.
All right, thank you, Yvonne.
Further clarification, that's our view on China. But on the market side, we are actually quite positive on the China market. I'm just talking about on the economy side, it's more difficult to implement and all that, but it's already starting from a very low level, and it just needs to continue to boost the domestic consumption and come up with more positive measurement that would be pretty positive for the China market. And there's a certain segment that will continue to do well, because this AI that is just starting to get exciting. Yeah, so there's still a long way to go. So on that front, we are actually quite positive on the China market.
All right, thank you, Yvonne. While we're waiting the US to talk to China, China has already started its ASEAN trip, right? President Xi Jinping is now in Malaysia, right? Given that the Malaysia's market has been weak year to date, allow me to pose this question to Yvonne, then followed by Mr. Tan. Malaysia market has been weak year to date. Is there any wish list from the visits, right, from President Xi Jinping to Malaysia that probably can catalyze the market again? Is there any sectors that can potentially benefit from here?
Okay, there is a lot of things to expect. We will see lah. These 2 days we have a lot of announcement, hopefully, okay, because this visit may also pose a bit of challenge, and then which particular area we're talking about. Maybe some project, maybe some construction project, maybe excite some property or construction sector. But we also have to be careful on other parts, because we are also negotiating with US. So in a way, neutrality of Malaysia have to be managed properly, diplomatically, because at the same time we are also negotiating with US about some of this tariff and all that. But at the same time, we are very positive on China partnership in many areas. But the way I look at it is that there are areas that we earlier on talked about, that some of the mega project, infrastructure project, that maybe the funding can be done by China. We do not know, but maybe some of these talks may start again. Yeah, we will see, because it's no point for me to speculate anything. Just wait for a day or two, we will have the full picture.
All right, Mr. Tan, do you have any wish list that probably the collaboration between Chinese and Malaysia can actually potentially benefit some sector? I think on top of that, Yvonne also rightfully pointed out that because it's also a very critical time to to have a negotiation slot, right, with the US. So with the Chinese visiting Malaysia, do you think that probably the neutrality of Malaysia can still be held? Over to you, Mr. Tan.
Yeah, thank you for the question. I think this has been the stand of our current unity government to stay neutral in politics and in economic terms, and we are open for discussion and for collaboration with both East and the West, right? I think that has been the stance of our current unity government, and our Prime Minister has made it very, very clear. And one thing about the expectation of the President Xi in visiting Malaysia this round is that economists are expecting that number of MOU, Memorandum of Understanding, will be signed this particular round. I think rightly pointed out from what Yvonne just now has also mentioned, area when it comes to the property and construction probably is one of the area that we are looking at. That is one of the more straightforward collaboration that we can look at in terms of the infrastructure development and things like that. And that is going to feel a positive confidence towards our Malaysian market. And to go back to your earlier question on Malaysia started with a little bit weakening momentum, is that we think for this year, especially the second half of the year, we are expecting Malaysia, I mean, if things playing out pretty well, we should expect a gradual recovery in the Malaysian market as well. And there are a few reasons. I think one of the reasons is that if you look at the currency stabilization, if you look at last year, 2024, the currency has been very volatile, right? If you look at between Malaysian ringgit and the US dollar, and that actually makes the exporter very, very hard for them to decide when to hedge back the Malaysian or US dollar and when to buy and sell or convert back the US dollar to Malaysian ringgit. And that is a challenge. And over the past few months, we started to see Malaysian ringgit and the US dollar has been gradually stabilizing. And that is the decision making for the exporters. So that's number one. Number two is that I think when we have more clarity from the noises on the tariff, Malaysian markets, like the confidence likely should improve. Because Malaysia as an exporter country, like it or don't like it, we are sensitive to the tariff noises unless there are more clarity from the US administrations. And by the second half, if we have more clarity on this particular tariff from the US to Malaysia and among the exporters country, and therefore we should able to see market to start to repricing again, and when they have some of the clarity into the market. Yeah. So thing for Malaysia market, we're still seeing that the current Madani economic policy still being implementing, still in a good place. And what we are observing is that is there any changes based on the tariff or geopolitical noises that we've been hearing. But so far, there's none at this juncture, but we shall observe further. Yeah.
All right, thank you. Very clear. I think it's good to wrap our session, but before that, I'd like to invite Yvonne and Mr. Tan to share some of the products or any funds that you would like to recommend to investors in this environment. Maybe Yvonne can start first.
Okay, let me start first. We have recently have a new fund called Asian Low Volatility Fund. Asian market is actually a pretty attractive valuation at the current level. So looking at the current level, if you look at the slightly longer run, we still have a decent growth and upside for Asian market. And low vol, I think, is working very well in this sort of a highly volatile market. So Asian low vol. And at the same time, at spring, we are quite positive on the China market, and we have started to be pretty neutral on India right now. But with the correction, recent correction of Indian market, India is actually coming to the valuation is not so stretched right now. So we are actually looking at entry level and selectively into the Indian market. So we are actually recommending to our investor to look at China fund. For us, is East Spring Investment Dynasty Fund, and also we have an A-share market. We also have a China-India exposure in a product called East Spring Dragon Peacock Fund. The Dragon Peacock, so it's an India-China fund, and also Asia Select Income Fund, which is in India, China equity, and also Malaysia bond. In terms of Malaysia, we are actually recommending to our investor to go into high dividend yield. So we have an equity income fund, East Spring Investment Equity Income Fund, conventional equity income fund, also Islamic equity income fund. Our equity income fund is consistently giving out a distribution of 5% yield to our unit holder. So in this environment, actually, high dividend yield kind of portfolio and a portfolio that a mutual fund that consistently giving out 5% distribution yield is actually very attractive for the unit holder.
Okay, all right. Thank you, Yvonne. Over to you, Mr. Tan.
Okay, in AHM or our Islamic counterparts Aiman, right? I think on the global space, we can recommend the Aiman Global Equity Fund. That is have an exposure into the value stocks, value holdings on the global. As today we have seen many of these particular holdings in the mega cap and large cap, which have a decent and a strong growth in terms of the earnings and profit that has been repriced lower down because of the tariff here. When during the second half or moving forward, when there is more clarity on the tariff by President Trump, we are looking into the improvement in terms of this particular upside on the global equity space. Therefore, Aiman Global Equity Fund is one of it. It's a retail fund. And if you move to closer to the home in Malaysia, I think we shall also look into the fixed income for clients who likes stability in your portfolio. Then AHM, Aham Bond Fund, is the one that you can look into. It has been gradually and very consistent over the past few years. And this is something that you want to have it in your portfolio if you want something that's stable. And last but not least, if you like to have some asset allocation into gold exposure, we do have Aham Gold Tracker Fund. So Gold Tracker Fund is a direct exposure on the gold prices in the market. So these are some of the areas that you can think you can consider as your portfolio diversification during this period of time. Yeah.
All right, thank you. Very clear from Mr. Tan from AHAM Capital as well. I think it's good to wrap up the session. We'd like to express our sincere gratitude to Ms. Yvonne Tan Hong Yan, the Head of Equities from East Spring Investment Berhad, and Mr. Tan Chi Siong, the Director, Intermediary Business, Digital and PRS from AHAM Capital. This update is brought to you by Phillip Capital, your partner in finance. Thank you.